This week, the market's golden child turned on it. Semiconductors, the engine of 2026's rally, tumbled into a bear market, and suddenly Wall Street is asking whether the AI spending boom has run too far, too fast. The Nasdaq dropped almost 3%, the S&P slid, and even the Dow couldn't hold green. But there's a twist that kept this from becoming a rout, and it starts with inflation. Welcome back to Wall Street Holic, where we cut through the noise and deliver data-driven market insights with no bias, no hype, and no distractions. Just the facts investors need to make smarter decisions. And because every conclusion is backed by research, you can download the full data-rich material using the link below in the description. This is your week on Wall Street for the week ending Friday, July 17th. Quick reminder, this is research and education only, not financial advice. So, what actually drove the week? Four forces. 1. The chip trade cracked. The semiconductor benchmark fell into a bear market, its worst week since early 2025, wiping out trillions in value. 2. A cooler than expected June inflation report. Prices actually fell, the biggest monthly drop since 2020, which cushioned the decline. 3. The banks posted a record quarter, telling us the real economy is still solid. And 4. Oil's war premium. Crude jumped double digits on US-Iran strikes. Chips down, inflation cooling, banks strong, oil hot. Hold those four threads. The chips cracked, inflation cooled, the banks flexed, and oil caught fire. 1 week, four forces, and the whole market hanging in the balance. Here's the scoreboard. US stocks were red across the board. The S&P down 1.6, the Nasdaq down 2.9, and the chip index in an outright bear market. The VIX jumped more than 3 points toward 19. But look at rates. Yields actually fell after that soft inflation print. The 10-year holding at 4.55%. Crude was the outlier, up double digits, while gold slipped and ether quietly outperformed. One tape, two stories, risk assets down, but the data helping. Stocks bled, fear spiked, oil exploded, but rates quietly fell, and that's the twist that changes the whole story. The macro data was the week's silver lining. June inflation came in at 3.5% versus 3.8% expected, with core well below forecast, and producer prices fell too, the biggest one-month cooldown since 2020. Add record bank earnings, firm housing starts, and improving consumer sentiment. The catch? With oil spiking, markets still price roughly a 63% chance of a rate hike by September, down from 75%, but still a hiking bias, not a cutting one. New Fed chair, Kevin Warsh, doubled down on rethinking inflation. Every number screamed relief. Cooler inflation, record banks, a resilient consumer, and yet the Fed's still leaning toward a hike. And that clock runs out when the next decision lands on July 29th. Bonds tell the cushion story. Early in the week, the 10-year spiked to a 2-month high near 4.62 on the Iran news. Then the soft CPI landed, and yields came right back to 4.55, basically flat on the week. The 2 to 10 curve barely moved, a steady, gently positive slope with no growth scare, and September hike odds eased to about 63%. In short, the inflation data bought the bond market, and by extension, stocks, some breathing room. Oil spiked the yields, then one soft inflation number yanked them right back down. And in that whipsaw, the bond market bought stocks room to breathe. Follow the money across commodities. Crude is the headline. WTI up 16, Brent up 13, as US-Iran strikes and a disrupted Strait of Hormuz slapped a war premium back on oil. That's the inflation cross-current the Fed is watching. Gold, oddly, fell in a broad metal sell-off, dipping below 4,000 even on a risk-off tape. And crypto held up. Bitcoin ended flat, Ether up 2%, both popped midweek on the cool inflation print before the airstrikes cooled things into Friday. Oil roared, gold cracked, and crypto shrugged it all off. 3 markets, 3 different stories about the same week. If you remember one picture, make it this one. Left of zero, risk assets, the chip benchmark down about 11 on the week, the Nikkei down more than 6, the Nasdaq down nearly 3, gold in the red. Right of zero, oil, up double digits, plus pockets of green in Ether and Hong Kong. It's a risk-off rotation, geopolitics lifting crude, while an AI spending scare wrecked the very chips that led this whole rally. Loud macro, but narrow damage. One line splits the entire week. Everything that led this downtrend on the left in the red, oil standing alone on the right, a market rotating hard, but not breaking. Winners and losers make the rotation obvious. On the winning side, the big banks with record profits. Goldman had its best quarter ever. Travelers surged on earnings, auto retailers had a monster week, and defensives like United Health, Walmart, and Berkshire caught the money leaving tech. On the losing side, the whole AI chip complex, AMD, Applied Materials, Micron, Nvidia, and in Japan, Kioxia down 16%, Netflix tumbled on weak guidance, and Intuitive Surgical fell double digits even after a beat. Money didn't leave the market, it stampeded straight out of the AI chip darlings and into the banks, the safe names, and the boring winners nobody was watching. Globally, this was a chip story. Asia was the epicenter. Japan's Nikkei fell into correction, with memory names like Kioxia down 16 and Korea's Kospi slid as SK Hynix and Samsung tumbled. That was a positioning unwind, not a verdict on those economies. Europe was mixed. The FTSE actually rose as defensives held, while the DAX fell on tech. And in China and Hong Kong, the Hang Seng managed a weekly gain, helped by China Tech and BYD. The whole world sold the same trade. The chip unwind ripped through Tokyo and Seoul, but the money that fled found a home in London, Beijing, and Hong Kong. 6 quieter signals worth your attention. 1. This was a momentum unwind. The momentum index fell 10% in July, while the broad market barely moved. 2. A new Chinese AI model from startup Moonshot helped spark the doubts about chip demand. 3. Money rotated into safety as Warren Buffett warned about gambling in this market. 4. Producer prices fell, so inflation is genuinely cooling underneath the oil headlines. 5. Even with record profits, Jamie Dimon flagged stretch valuations. And 6. Gold cracked below 4,000, an unusual risk-off tell. 6 quiet signals under the noise, and every one of them says the same thing. The smart money already started moving before the headlines caught up. So the bottom line, in 3, 1, this was a reality check, a valuation and positioning reset in the most crowded trade on Earth, not the end of the AI cycle. 2, cool inflation was the cushion, the single reason a chip bear market didn't become a full-blown rout. And 3, oil is the wild card, reviving an inflation risk that could cap a rebound and complicate the Fed. Our mood index reads 4.3, risk off but cushioned. The verdict, buy the dips, but stay hedged. Overall, not a funeral, a reality check. The most crowded trade on Earth just reset, inflation caught the fall, and oil's the only thing standing between you and buying this dip. Looking ahead, the calendar gets decisive. Monday and Tuesday are quiet, then Wednesday is the marquee evening. Alphabet, Tesla, and IBM all report. Our first Magnificent 7 read, and the swing factor for this entire chip debate, because it comes down to hyperscaler AI spending. Thursday brings Intel and the flash PM is. Then, on July 28th and 29th, the Fed meets, a hold is expected, no new dot plot, and the hike debate rolls into September. Everything you just watched comes down to 1 week ahead. Wednesday night, the Magnificent 7 start talking, and the Fed gets the final word. And that's your week on Wall Street. To recap, chips cracked into a bear market, a cool CPI cushioned the blow, and the banks reminded us the economy is still solid. Next week, Alphabet, Tesla, and the Fed take center stage. Wall Street Holic cuts the hype and run the same database process every single week. Honest about what we know and what we don't. Don't forget to download your copy of the material in the link from the description below. If that's your kind of coverage, subscribe, like, and share. This is a subscriber-led channel, and the more of you who ask, the more deep dives we make. We'll see you next Saturday for a market recap. Until then, stay sharp and stay hedged.